Started.
You're looking at a different image than I am then.
Good morning, everybody. This is Dennis Wilborn with the Active Trend Traders, and as you can hear, Mike Traeger from Dallas, Texas is with us today. I don't know if Michael is joining us from Europe or not. He basically sent me an email the other day, said he was going on holiday because he's tired of what's going on in the market. So anyway, Mike, how you doing today?
Doing well. We've got some decent weather here. I'm not complaining.
Yeah, we believe it or not, they're expecting a big El Nino in California this year. So who knows, with all the drought that's been going on for the past few years, much of California may be just, swept into the ocean due to mudslides and all that kind of stuff, which is in a way unfortunate, but sometimes, yeah, anyway. I won't go there.
Well, that beachfront property in Nevada is looking better all the time.
It is. And the tax rates in Nevada is a lot better than California, too. Anyway, I want to welcome...
Yeah, well, once they've got property on the water, I think that tax rate situation will change.
Yeah. And so I want to remind everybody that everything we do talk about with the Active Trend Traders, the early warning alerts, is all for trading purposes only, and traders should always paper trade any new method prior to the risk of their own personal capital. Here's Michael's disclaimer, if he were with us today. It's a specific for European markets. At the Active Trend Trader, I believe I'm strongly in training, educational part, and then experiential opportunities that we do through Active Trend Trading. This coming Wednesday night, we start a three-part series that'll finish off the rest of 2015, and it's a three-part series on planning for wealth. I'll be presenting tomorrow at the Bay Area Moneymakers, talking specifically about this, but some of the things that we've put together that are beginning working with the Active Trend Trading strategy number one, providing a little bit clearer and simpler approach to portfolio building. So here we are, Mike. Here we were, I think this was 2 weeks ago, just before Thanksgiving. We took Thanksgiving Friday off, and we had an upside reversal in the stock market the previous week, but it was in a trading range, and we find ourselves still in a trading range. What have we had this week? Well, one, volatility based on reactions to either news and or rumors has returned into the market. And then we're getting some uncertainty. When we get in and start looking at the individual charts, we will see the big ranging days have come back. In other words, where you get a lot of range or a lot of movement on a daily basis, but each day kind of erases itself, and it makes it a little bit of a challenge to trade around unless you're a real short-term trader. And we're trying to be a little bit more conscientious in doing that. So I'll call it right now, we have uncertainty and mixed signals. S&P stuck between support and resistance. NASDAQ stuck between support and resistance. Russell still showing as the weakest of the our three tracking indexes, but again, stuck between support and resistance. Sounds like a broken record. Outside influence, earnings seasons basically is done until we get into the fourth quarter earnings reports that will get started towards the end of January, going into February. Will we see our Santa Claus rally? Somebody on our Wednesday night session, David pointed out that like last year, we had a little bit of a sell-off into the midsection of December, and then a pretty good rally into the end of the year. We'll see if that's going to happen. And what do we have to look forward to this year, or going into next week? Excuse me. The Fed raising rates, and then also global instability, and perhaps to some extent, I don't know if how many of you, many of you are, well, I'm sure all of you are aware of the terrorist attack that took place down in San Bernardino. potential of these little, isolated cases, I won't call them isolated, but planned cases of terrorism attacks that are here on the United States mainland now. Could that shake our confidence in our economy? Because clearly, Mike, the probability of the Feds raising rates this coming Tuesday is very high, even while the ECB basically reduced rates again and trying to stimulate the European market. But yeah, I read a little bit of a piece this morning, Mike, that talked about, well, we got a good labor report or jobs report today, and therefore the Fed says, okay, that's enough of a sign so they can raise rates on Tuesday. Don't you think that the Fed is kind of taking their data points, too short, in such a short period? Aren't they looking at the big?
Well, you want to get me started talking about the Fed again?
I want to get you started, man.
It's ridiculous. I mean, they've been talking about this for a couple of years, and they've had all this time to get ready. You're 7 years into a zero interest rate, which is virtually unprecedented, and you're going to base your decisions on the most recent data that comes in, the week before the meeting or the announcement. I mean, come on. And it's the same thing it's the same excuse in September. And, people tend to have short memories, but, going into the September Fed meeting, Yellen had dropped a lot of hints and had created an expectation that they were going to raise a quarter of a point in September, and everybody in the financial world was expecting that. And then, at the end of August, the markets here had, a pretty severe sell-off as a reaction to some bad news out of China. And this was a couple weeks before the Fed announcement. And despite all the expectations for them to take action in September, they didn't do so. And the excuse that they gave was turmoil in the financial markets and some of the bad news out of China a couple of weeks before that. And it just seems ridiculous to me that, given their status as the most powerful central bank on the planet, governing the most powerful economy on the planet, and, trying to manage a multi-trillion-dollar economy, that, they are going to base what should be, longer-term policy decisions affecting, the whole globe, basically, on the employment report that came in the week before. I mean, it's just crazy.
Yeah, absolutely.
Crazy.
What's that? Crazy? Crazy what?
Seems crazy to me.
Yeah, I kind of sit there, and it's almost like what side of the bed they got up on in the morning before the Fed meeting, and that's going to make the determination of whether they raise rates or not. But I think one of the things with the Fed right now is, I got an email from one of our members, and basically the question was, if the Fed raises rates, what's the market going to do? And I'm sitting there going, well, here's my answer to that. It's going to do one of three things. It's going to go up, it's going to go down, or it's not going to go anywhere. The financial markets are betting that the Fed is going to raise rates, and they may already be starting to price in a little bit of that. So typically, the real answer to what's the market going to do, depending on the Fed decision, oftentimes isn't totally known until 1, 2, 3 days after the Fed meets, after they've had a chance to digest all the verbiage, digest the slant, read between the lines, look at the tea leaves, and then the market decides on a direction and goes. And so, a lot of times on the Fed week, I kind of just keep a low profile myself. I'll let my existing trades run and with my, following my rules and all that kind of stuff for stops and profit targets and all that kind of stuff. But I don't necessarily go in and make any big bets before the Fed meets. That's just me.
Yeah, it's almost like an earnings report on a stock. Even if you think you know what they're going to do, it just becomes so unpredictable as to how the market's going to react.
Yeah.
Or don't
exactly.
do.
I would say that if they don't, if they do not raise rates on Tuesday, they will lose additional credibility, the little bit of credibility that the Fed has right now. I think that'll wash it totally away, and people think that it is an impotent and worthless organization.
I would agree with that. I think if they don't raise rates, and I think there's very little chance that they won't, but if they don't, I would expect all hell to break loose in the financial markets, because of that loss of credibility.
Yeah.
And you may get the knee-jerk reaction to the upside, but remember what happened in September after they announced. They weren't going to do anything, and people were expecting them to, and the markets, sold off almost back down to the lows, at least for the S&P, to the lows in August, where that little double bottom was put in, and then you have the real strong bounce off of that. But the initial reaction to the announcement was not positive.
And one last comment on the Fed, and then we'll move on, is basically my comment is that I think Janet Yellen is so afraid to make a decision because of the potential reaction. And a lot of the elites in our country have gotten to the place where they're thinking that everyone deserves a trophy and they don't want the market to hugely sell off. That basically she's a deer in the headlight, and she's got to do something to prove that she has the guts to do something, because how long she's been, she's been in office now, or had that position now for almost 2 years now.
About 2 years, yeah, I think. Yeah. And don't forget she was the vice chairperson for a number of years when Bernanke was at the helm.
Yeah, and and she's establishing her legacy right now. So, hey, here we are with the percentage of stocks on the NYSE. What's that?
She's establishing her legacy, be that as it may.
Exactly. So here we are, percentage of stocks above the 20-day moving averages as of the 11/20. As you can see, we had done a nice little rebound, hadn't generated really any buy signals on the early warning alert system, and here we are 2 weeks later. What is this telling us? Basically, it's telling us that we've got there is still weakness in the internals of the market. The participation rate by many stocks in the current, uptrend / rally, it is still at a low rate. As you can see, we had, this represents the two sell-offs we had earlier in the week, and both Mike and I have been talking for quite some time about how the indices that are basically not weighted have been showing there's a underlying weakness in many stocks. This particular indicator, a particular chart, does measure a non-weighted index ETF on the NYSE, and it basically, we're seeing a lot of the same type of action in the Russell, which is also a non-weighted. However, in the NASDAQ and the S&P, both of them have been, moving back up towards their previous highs. while the Russell and the NYC has not even come. As a matter of fact, it's been sitting about a 50% retracement from the highs of the year to the lows that we experienced back in September. And so that's what we're seeing right now. If you take a longer term look and go into barchart.com, go to the momentum indicators and look in there and check out the the percentage of stocks on the NYSE that are above their 200-day moving average. And you may have to look at that on a weekly basis. That way you can go back and check, several, about 5 years worth of data. And it has been lagging, Mike, down in the 40 to even, below 25 level, saying that, a large percentage of the stocks on the NYSE are actually below their 200-day moving average.
Well, yeah, certainly a large percentage. It's greater than 50%. And if you pull up, people who are listening want to go in and pull up that chart, and you look at a weekly chart going back forward, you'll see a chart that shows that the percentage of stocks above the 200-day moving average has been in nothing but a prolonged downtrend, consisting of lower highs and lower lows, for years, as the cap-weighted indexes have been doing nothing but putting in, all-time highs.
Yeah, exactly. And so, hey, some clarification.
Huge divergence.
Yeah, it absolutely divergence between the indexes, and so clearly the market and the indexes are not totally in sync with each other. David just wrote up that the expectations on the rate hike is that the expectation of it happening is strong, but that they will continue to happen at a very slow pace. And Dave, yeah, Mike and I aren't saying that the rate hike is negative. What we're saying is that just, the Fed's inability to take action is interpreted oftentimes by the market as being negative. And Dorothy says that Yellen was sworn at on February 3rd, 2014. So we're pretty close to 2 years.
Right.
So let's take a look. What's next? Okay, the markets themselves. Taking a look on 1120, the Dow had eked its way into positive territory, and the NASDAQ was up about 10%, and the Russell was down about 2%. Well, it looks like things haven't changed a lot. Dow has eked its way back down into negative territory year to date, and this was as of about 9 o'clock this morning. S&P is up slightly. The NASDAQ has been maintaining right around a 10% gain for several weeks now. And the Russell is back down about 2.5% from where it started the year at. So let's take a look at some individual indices. And what we have here on the left-hand side, we have the daily chart. On the right-hand side, we have the weekly chart. And part of what I wanted to show folks is in these last 4 days, when the range of the day started to get larger than any of the past days, and then all of a sudden you get a big up day followed by a big down day, followed by another big down day, and as we're sitting right now, followed by a big up day. This is when the market it becomes very unpredictable, if you will, because we're not getting some tradable trades where you get some small bodies and then will ricochet, and it looks as if it is non-uniform. Very difficult to judge what's going on with the market and plan trades around it. You can plan trades around support and resistance. And that's basically what you have to wait for when the market starts going into one of these movements where it looks like this, where we basically have bounced up, we've bounced down, and now we're bouncing up again. Now, a positive is this would be considered a higher low, and however, we've got to see a move back above, a sustained move back above the 2100 level. And I've got an alert going off. Same thing over here on the weekly chart. What we're seeing here is these huge days. Okay, had a spinning top, what would have been a hanging man doji last week. However, it wasn't really reversing a downtrend or uptrend, excuse me. And so today we're just getting a very wide range weekly candle. And so what we do know when we get these wide ranging candles is, one, you've got strong resistance at the top and strong support at the bottom, and clear, sure enough, yesterday it pulled right down to this 2043 level, and it looks like today it's trying real hard to push back up to the 2100 level. We'll see if that takes place. What do we have going on over here? As you can see on the momentum, we're starting to sell off, and the true strength indicator also rolled over, but now it's trying to kick back up. So we'll see if this kicks back up and goes back into an uptrend or not. What do you think on the S&P, Mike?
I think the best commentary on what's going on with the market and with these charts is what you told me about your friend Michael in Switzerland, who sometimes joins us on Fridays.
Yeah.
And his email to you about why he's not with us today.
Yeah, he's on holiday, man.
He's on holiday. Why is he on holiday?
Because he's tired of messing with the market.
There you go. So here's a guy in Europe, in Switzerland, who is an investment advisor and managing money, and he's taking a break from it because he's kind of fed up with the way things are behaving. And, when you ask for commentary on these things, I mean, I think that kind of speaks for itself.
Yeah. Actions are sometimes the best commentary that we can get. And so, excellent. And so let's go on to the NASDAQ index. And I want to take a look both today at the NASDAQ and this is the NASDAQ 100 and the NASDAQ Composite. As we can see, we pulled back above the, and we had some, this breakout area about 46.94. Well, we dropped that like a hot rock yesterday, and the day before, and then followed that up with a follow-through day, which is immediately being reversed today. Par for the course until we get basically a close, that takes out these past highs at 47.39. We are currently in a sideways trend. One of the things that is quite interesting, those who follow the active trend trading system, look at this little bounce here off the 8-week that happened. I think it was yesterday. It would have been a gutsy call to say, hey, I'm going to take this bounce off the 8 period, because the 8 period yesterday, let's put in show you where it was yesterday, which is about right there. Would have had us basically get in at yesterday's close after that big ugly down candle. It would take Wavels to get in on a situation like that, because in reality you don't have a reversal signal. All you'd be playing is the bounce off of the 8-week. It can be done. One could have gone in this morning and said, okay, if I start to move back above the 8, I'm going to go ahead and jump in with my stop being right below it. But those are the kind of little tweaks one has to do when we're not getting really good solid entry signals. You have to go back to it and apply what you know about the 8 weeks. But I just thought I'd bring that up. And again, recognizing that where do you expect it to go if it bounces here? Right back up to resistance, and it's in the process of doing that. One of the things that I have noticed over the last couple of weeks, though, Mike, is we actually have our momentum on a weekly basis going down, and on a weekly basis, the TSI is going sideways. And so it is at a, back up at the highs. A lot of ways to interpret that. Similar thing over here. We had momentum rolling down, but now we're getting a nice reversal. We'll see what happens as we move closer to the end of the day. And secondly, again, I will be very light the market, except some of the stocks I own. I'll be very light the market as far as the index ETFs until after the Fed meets. Dorothy says, if rates go up, does the debt a company has need to be taken? Yeah, Dorothy, what happens if the rates go up even a little bit? Depending on the type of rate, debt the company does have, it can cost them more money to service those debt, even if we only go up 0.25%. And that's one of the reasons why the small cap index tends to react a little bit more negatively to, increases in interest rate than the other indexes. You got any comments on that, Mike?
Well, the comment is, and the big scare about, any mention of interest rate hikes is that if corporations want to issue bonds or take out loans going forward, they're going to have to pay more interest on those obligations. It may not affect the bonds and the loans that they're currently holding, because those are already done deals, unless they have some kind of an adjustable or variable rate attached to them.
Yeah.
But if they're fixed, then they don't change.
And so there you have it, Dorothy. So more interest, yeah, David, more interest, less profit. It impacts their bottom lines. And that's where it impacts the smaller, the small cap or the, startup type companies, or the, small companies to a greater extent, because oftentimes they have more debt. So what we got?
Well, I think the bigger consideration in all that is the U.S. government, the national debt, which is beginning to approach $19 trillion. And we know that the government needs to constantly borrow money and sell by selling treasury bills,
right,
to finance its operations, because it doesn't bring in enough in tax revenues to pay for all the programs that have to be paid for. And some of those shorter term treasury notes get turned over every 30, 60, 90 days.
Right.
So there's an immediate impact to the cost to the government of servicing their debt with any kind of an interest rate increase. And with those kinds of numbers, the cost becomes, in terms of just dollars, pretty significant.
Yeah, in the federal budget, the servicing of the debt continues to become a larger line item, which is, of course, what concerns all of us. And, and there's two different approaches. One, bring in more revenue. Unfortunately, oftentimes bringing in more revenue does not, they also attach to that spending more, or spend less, tighten your belt and spend less to meet the revenue that you have coming in. But we could get into a whole discussion about that. We won't. We got the Russell. The Russell.
Yeah, that's a whole nother topic.
Russell has come down, and it too stopped right there at that level. Has come popping back up through the 8-week moving average. And so it may maintain that and move higher, but clearly is operating between, we got this little bit of a Pinocchio breakout. Pinocchio breakout is when Pinocchio's nose would go and then comes back. That's what we got kind of going here over the last 1, 2, 3, 4 days. And then we started selling off on Wednesday and dropped all the way back down to support just below the 50. And now it's got a nice little rebound today. It's not been enough of a rebound yet to turn the TSI and or the momentum back up. And again, on a weekly basis, we've got the weekly momentum turning over. This is kind of rounding. One thing I find kind of interesting on the Russell, and this is why I like the Russell a little bit more for potential trades moving through the end of the year, is from here to here, the Russell has been very orderly. Nice pattern you can recognize, popping back up to resistance. Nice pattern you can recognize, found support here. And one of the things on technical analysis, when you've been operating here in a trading range, oftentimes when you get a pullback down to the midsection of the range, this works specifically well for individual stocks, but it can also be applicable to the indexes. And you get a reversal here in the midsection that can be considered bullish longer term, because the sellers didn't have enough oomph to push it back down to the past level of resistance. So when you see a pattern like that, which you can't see because I've drawn too much in it, but when you see a pattern that starts looking like that and you get a pullback and then a ricochet bounce, that can be an indication, a clue that there's a potential additional upside still left. What would be quite interesting is if we do break out of this level, how much of the distance between how much of the distance between here and the past highs are you going to actually recover? And that's what I'm looking at. Is that's a much more significant amount back to its past highs than what the S&P and the NASDAQ currently open, because they're already up at their past highs. And so we may get all the way up and then crash going into 2016. We may get a partial way up, halfway up, but halfway up would still be a pretty good trading range on the IWM or TNA. And so, yeah, Kieran says I indicated on Wednesday that TNA would potentially go down to let's take a look at TNA real quick, to about the 70 level. Well, not tan TNA, silly. And it did. And then we are getting a nice little rebound here. Again, you may ask the question, well, why aren't you in that trade? Well, it really hasn't offered a signal to get into the trade. That's why we're not in a TNA or the IWN trade whatsoever at this particular time. So you got anything on the Russell, Mike? Let me get it back up.
Nothing we really haven't highlighted before in past sessions. Except to again notice the discrepancy or divergence between how the weekly chart on this looks compared to the weekly chart, say on the S&P or the Dow,
yeah,
or the NASDAQ specifically.
Yeah. Question came in. Joe asked the question: why wouldn't small caps do better with higher interest with rising interest rates? And typically it's primarily because of the potential impact to their bottom line, because the money that they need to borrow, have to borrow, and if they have an adjustable rate on the money they have borrowed, that is an expense that goes up. And oftentimes those individual small cap companies are already working with a paper thin margin, and so it can impact them. And typically rising interest rates, again, historically has somewhat retarded the how well the small caps have done. Does that sound right, Mike?
Yeah, that's very well said. That sounds about right.
And one of the things that's kind of, I'll share with everybody, one of the things that can be kind of to be cautious about is because we have been in a very low interest rate environment now for almost 10 years, at least 8 years. When we go back and look at the historical data on the individual indexes, keep that in mind. And by and large, the Russell has done very, very well over the past 10 years. And the last couple of years, it has lagged the other indexes. Okay. So that's where we'll leave off with that. Path of least resistance. The path of least resistance and the path of success is never a straight line. I think we're seeing a lot of that work out currently. We don't know exactly, is the path of least resistance for the market up or is it down? And it's just going to depend on what the individual institutional investors are thinking that will start driving the market back up to the higher levels, or leaving them where they're at and driving them down. I know there's been a lot of verbiage, Mike. I know some of the things that you read from like David Stockman and some of the other folks. They're looking for a significant fall out of the sky crash in 2016 sometimes, are they not?
Well, I've been reading this stuff and hearing this stuff for a year and a half now, and for a year and a half, everybody's been expecting a big, correction in the market. I mean, certainly more than, what happened in August. In fact, a lot of these people say August was just a preview of what's coming next. We've been hearing it for a year and a half, and we haven't seen it yet. So I do believe and I do agree that, based on historical, just based on historical precedent, that there is going to be another big move down in the overall markets over a period of a couple of years, similar to what we saw in 08 and 09 and 2000 to 2002. Move of that type would be kind of normal in a historical reference or perspective. But the timing on that, remains to be seen.
Yep. So, Ryan, want to remind everybody about the active trend trading system. Our motto is to clarify, simplify, multiply. We apply the 5 pillars of active trend trading. Basically, we show folks what to trade. Top quality IBD growth stocks and or index ETFs, both leveraged and non-leveraged, where to enter, where to exit, what strategy we're using, and what we expect, and we share that on every trade. We developed the active trend. Mike and I have been working with the active, various pieces of the active trading system, basically gone back to, I want to say 2007, 2006 time frame, where Mike and I started having coffee at the Rancho Shopping Center, Starbucks in, where was that at, Mike?
Milpitas, wasn't it?
Yeah, Milpitas. And we'd get together about once a month and chat about what's going on and that kind of stuff. And one, developed a really good friendship, but also we'd hack each other up about what we're seeing in the market. So it was a very good training place. But we've attached to the active trend trading systems 3 strategies we focus on: stocks and index ETFs. That's strategy number 1. Look to be that more the wealth building basic options. Strategy 2, which we only allocate a very small amount, and then wealth in building income generation using leaps. Here's where we are finished. Here's where we are as of today. Close of business down here, about 13.5. And here's some of the strategies. Strategy 1, we've been focusing on that a lot over the last few weeks, and it's been doing quite well. Closed NOAA trade, CBM trade, Facebook trade. We jumped out of that with a small loss. Now trade is currently doing quite well. And then Hawk we got into yesterday, and then the strategy 3, we did an IWM, selling IWM calls, and pulled out about $240 on that for the week. Overall, here's our monthlies. And Mike and I talked a little bit about this on Wednesday, is what happened here, September of this past year. And what happened there is Mike and I had a heart-to-heart talk about, okay, what's going on? What am I missing as I'm making the calls on various stocks? And one of the things that it was is, I think Mike, you said that we had that I had other things kind of come into the system that shouldn't be there. So we cleaned house, got rid of all the junk that shouldn't be there, went back to triggering primarily off the 8-day moving average and writing those trades. And as you can see, September, October, November, we averaged about $3,300 per month, which puts me, if we've been doing that all year, it would have put us right in the sweet spot for our 40% target per year. We are up to a 63% win ratio. So here's a couple of trades that we have done here recently, and this was based on bounces off the 8-day moving average. And NOAA, we entered NOAA at 11.19. Here, a bounce off the 8-day moving average. We were able to exit that. Actually, we are actually able to exit part of that the day after at, with a 10% gain. $755 gain, and then we put the position and stop where we were break even on the rest of it, and it got taken out yesterday. Now, NOAA may set itself up because it's a really nice strategy, and so we'll be looking for a potential to move higher on that. Another one, CBM, we got into the trade around the 19th also. And this is all tying into our portfolio building for strategy 1. It triggered on 11.17, pulled back to the 8 on 11.19. We entered at 49.40. We hit T1 54.30 on 11.27. That was the day after Thanksgiving. So we still have half the position, and it looks like it's starting to take back off, but we closed out and we profited about $857. So we have a BAM meeting tomorrow. Our Bay Area Moneymakers meeting in San Jose. If you are a BAM member, please come out down and to the meeting. We're going to be talking. I've basically done some back testing based on Lee Tanner's approach to portfolio building, but I did it using the active trend trading system for triggering in, and also using some Lee strategy for triggering out of the trade in the attempt to build a portfolio starting with only a $5,000 account. And I'm really so far very impressed with how well that's done through December of, through this week. So early warnings alert posted and to the website and YouTube channel. So for the folks who will be listening to the recording of this, or if you're not, you haven't become part of the active trend trading family yet, our rates are going up. Membership is going up in January, but up until the end of December, you still have an opportunity to jump in at a 40% savings on the active trend trading membership, or a significant more than 50% trading on the early warning alerts, which has hit every one of the market lows this year so far. I'm not a big promoter kind of guy, so I don't spend a lot of time there. Anyway, see you next week. Have a great weekend. Keep your egg growing. And I got a couple of questions here. Do you expect to start a new position for strategy 3? Yeah, Kieran, what we'll be doing is basically closing out the existing IWM positions soon, probably prior to the end of December, and then starting up a new position in utilizing the January 2017 either IWM and or Spiders approach. I sold out of AGO with a nice gain. This is worthy, using earnings sales rules. Marcus Smith is saying new pivot about 150.50. Our consolidation patterns strong or weak? That's a great question, Dorothy. And on consolidation patterns, basically what we're looking for is they will establish a new low range and a new high range, and prices will typically bounce within that, and oftentimes that consolidation pattern will tend to run, this is a rule of thumb only, about the same amount of time as it took for the initial move up. So you can go back and you can measure that amount of time, then just lay it on your calendar across and expect that consolidation range to take about the same amount of time. Scott, what about KMI? Worth a look at these div rates. So, hey, with that, that's going to conclude today's session. Now we're ready to look at some stocks. Mike is bugged out, and so I get to do what I love to do, look at charts. So who's got here's another stock that we were in, that we actually got in this week that has, we got into this stock here at about 86.62. I'd like to see it continue up. Got an initial target up, just over the 92 level when it hits 10%. But this is one of those very strong stocks that we're looking at. Sell half of it, but then let it go from there. So KMI. Yeah. Scott, since I don't follow interest rates real close, or the entities or the investment items that basically follow that, but yeah, look at that's kind of really falling out of the skull. Is this a corporate bond type oil play? Okay, thank you. Yeah, with the big glut in oil. That right there looks a lot like an exhaustion move to the downside, though, for a weekly basis. As you can see, it's been falling out of the sky. At some point, look at the dividend, which is safe. Again, I don't focus on, I'll be straight with you. I don't focus on dividend trades because many of the growth stocks that we do focus on do not pay a dividend. And I think that there are other means to generate monthly income or quarterly income that can be more substantial than collecting dividends. Although I totally understand why we want to why folks want to collect dividends. But yeah, well, that's falling out of the sky. Yeah, potentially I'd have to, Scott asked if it's a covered call candidate. Potentially we'd have to take a look at what is available in their option strings to see if that would be viable. If they're not very liquid in their covered call chain, I would say, not at all. So let's look at LGIH. Okay. Again, you should see on the majority of these stocks looking very much like the indexes and how they've operated and reacted this week. And sure enough, we get a two-day sell-off from a high. We've come down to the 50-day moving average. Now let's see if it consolidates here or immediately rolls back up. But what I'd be interested in doing is I'm liking this because, and then a clue to everybody is like, let me get my pencil back, is while it's okay to buy, like on the first couple of times back to the 8-day moving average, once it extends past that, after about the second or third trip back to the 8, you may want to be careful because by that time you've got the TSI in an upper position and oftentimes a momentum. Where we want to be looking is this constructive kind of work that starts here or back in here before it first pops above the 8, and look where your indicators are. Your momentum indicators are quite low, and what tends to happen is once you start moving back up, you'll get your most significant gain, like right there. That's a 20% gain from when it gave us our initial buy signal on LGI. And so you get your, a stronger gain You know, you buy over here, you may get a 10%er, and that's okay. And then you can wait and add to the position. Both are totally appropriate. Let's see, KMI. Yeah, if KMI January 20s has a volume of 14,700 on their that would be a good thing. But that hopefully that volume will see it across the board. It won't just be in one specific strike price. It doesn't have to be the same amount in every strike price, but you want to see a little action in most of them. Dorothy asked a question, IBD Review has a lot of low ROE and thin companies. What's up? And stock of interest, LED, bought at, that's a sneaky way to sneak in a stock for review, Dorothy. Oftentimes it's with IBD is the when you start getting stocks in that have the low ROEs, the thinly traded stocks and all that kind of stuff, many times, not every time, but many times, that is an indicator of that underlying weakness within the market. In other words, they're starting to list junky stocks, and that can be a indicator that things aren't as good in the market as we think they are. And I've seen that precede, massive sell-offs in the market. I'm not saying that's going to happen, but it has happened in the past. LAD, kind of a low quality as far as low volume stock, but it's got a pretty nice pattern here. We're popping back up above the 8-day today, and we'll see if it continues to push higher from there. What's your potential on this one? If you say it closes above the 8, I'm going to take a pullback to the 8, then back up to the highs is about a 2.47% gain. Okay, that's it on LAD. The range is, I mean, it may be okay, Dorothy, but it is a little bit limited as compared to some of the other stocks. One of the stocks that I'll just throw out here for you to keep your eyes on, guys, is this caught my eye this past week. It would have been a terrific buy point today, but from the time it broke above the 8 down here, and let's say you got in on an entry point right here at 28, this has rushed up 30%. Under good buying volume in the past 16 days. I'm keeping, and it looks like it is trying to turn around. And so I'm really liking this. And again, it would have been actually would have been a pretty good entry today. It's up 220 from the 8-day moving average. And so what else we got? REGN. And it had good ratings in the IBD stock checkup and that kind of stuff. RGN, yeah, it looks like it has come down. It did make a new low and broke back through its previous swing low. And let's see if this buying today is on higher volume. It may be turning itself back around. And if we get a close above the 8, then I would look for the 8 for an entry. And what's your potential? About 7%, but on this 7% to 6% would be about $33. Oftentimes on these higher value stocks, I'll look to trade a couple of contracts on them and just take advantage of the move up from there. PCLN, Priceline. What's Priceline doing? On a weekly chart, the Priceline is below its 8-week moving average, but it's showing some positive action here. And it may be in the early stages of a turnaround. It took out this, it hasn't taken it out 100%, but this swing high here. And so it looked like it may be consolidating and starting to work its way back up. definitely a stock worth keeping your eye on. Again, this is one of those high price stocks. You're going to buy fewer shares or one or two contracts, because I mean, look at this. This moved $18 today, and so one contract can still be very rewarding. One call contract. Okay, what else we got? FIX. Yeah, low volume, less than 500,000 shares per day. Yeah, it is making a nice little move up. Had a jump up and then a sell-off after earnings, but it's got a nice little uptrend going, Tracy. And from here where it hit its low, where it broke out last time here, it's up about 7 to 8%. Looking kind of interesting, maybe turning higher here. From the, when it became viable, yeah, it's up about 105% from the beginning of January 2014. T. Yeah, AT&T. AT&T is moving back up, but AT&T, I mean, it's got a pretty good range here, about 12 to 15%, but it doesn't excite me. I mean, excite me is not a really good term. AT&T is not a growth stock. It basically is, you're not going to get a huge move up in it. It may pay a really nice dividend, which this one pays about 47 cents per quarter. But at the same time, you're not going to get the accelerated wealth growing potential from an AT&T, because its growth more or less is behind it. I think we're starting to see a similar type of thing happen with Apple now that it has become so huge that it was put onto the Dow, and so the Apple's in the process of becoming another Microsoft. Again, I mean, it's a great stock, Scott, and there are trading opportunities with it, but like that move, well, over the last 20 days, 19 days, it's gone up about 4%. But if we go back to the beginning of the year over here and take a look at it, it basically for the year has gone nowhere. Okay, last one, FIT. FIT did a big sell-off, Tracy, and it may be trying to right itself, and it looks like it is. It came down here, gapped down, did a consolidation, started back up. Some buying has started to come back into the stock, and so I would definitely, look at this. I would want to run the IBD stock checkup on it to make sure it's fundamentally sound as a growth stock, and then move from there. And what's potential from the time, from there to there? Yeah, it's gone up about 11%. But right now, and I would be looking at this, waiting for it to close probably back above the 8-week moving average, or get a retracement back here like this that comes back to the 8 and then bounces higher. I'm in at 28 a few days ago. Okay, you got it pretty close to the bottom. So you are currently up about 12.5%, 4%. So I don't know if you took it, buying it off the 8 after it's closed above it or not, but yeah, I mean, I would just watch it. It looks like it's trying to turn around, and it's doing this consolidation thing. It may run into resistance right here about the 32.35 level, which it already has. And so it, other than that, it looks like a good potential for a turnaround. So with that, folks, I'm going to call it a day. And you guys have a great weekend. If you do happen to come by the Bay Area Moneymakers tomorrow, we'll have some great coffee and some really good snacks. We meet at the San Jose Masonic Temple. See you guys. God bless.